This is episode 44 of the More Doors podcast. We have an amazing guest, Ryan Tanel from Top Producer Investment Capital, joining us today. We'll be right back with an episode and my amazing co-host right after this. Boom, dim, boom, dim, boom, dim, boom, boom. All right, everybody, welcome back. We are here, episode 44, very quickly closing on number 50, which I'm really excited about. We still got to figure out what we're doing. I'm here with my amazing co-hosts, Brian the Force and Nick. Not just good. Nick's not just good. Nick is amazing. So Nick, good?
No truck good. Because that's why I missed last week, because my truck was stolen in front of my house.
That is not good. That's bad. Tell us your version of the story, because this just does not happen in our area every day.
I go to sleep on Wednesday. And do you want me to tell you all my Wednesday night routine?
No.
Yeah, okay.
Skip that part.
Okay. So I go to bed. And the funny part is Heather, she's pregnant, so she's had trouble sleeping, which ironically, my truck was stolen while she was actually awake.
And she just sat there and didn't do anything.
So the next day, it's Addie's last day of school. And Heather goes and always takes beginning and end of day, first day of school and last day of school photos. She goes out there with Addie, and Addie's like, "Where's Nick's truck?" Heather didn't think anything of it, which I don't know why at first. Comes back in and she's like, "Where's your truck?" And I'm like, "Well, it appears to be stolen because we drove it home.
Because I'm here.
I'm here. I didn't drink that night, so it's not like it's been left anywhere." And the Ring, by the way, the Ring camera is great, but it's not great because it doesn't pick up everything.
If you don't get close enough to activate it the first time,
that part sucks.
It's not going to record.
So
it's not always recorded.
Between 2:44 a.m. and 3:44 a.m., 1 minute's there, the next minute gone.
Whoa.
Just vanished. And then luckily the neighbor's house had some cameras. It picked it up. And it was just three dudes driving around in a Chevy Impala, pull up behind it. They go to the passenger side. They do something, lights come on, and they jump in. And the detective was saying that they now have these master key fobs that they can program to find your frequency and then just get it on and take off.
How fast?
It was gone
gone in 60 seconds.
Less than that.
Yeah, that's from the 90s. It should be like 30 seconds now.
It's everything's like 6-minute abs, and it's like 5-minute abs. So this was like, I think they were gone in less than 15 seconds.
So what are you thinking for your new car?
Ooh, I've been looking at a lot of things.
Monster truck.
Monster truck. The 6-wheeled vehicles.
Yeah.
I'm definitely looking at those. I just can't justify spending 150 G's on
about that Raptor 250.
I'm looking at the Raptor. The Raptor F-150, the 250, they don't really make that. They make something else, but it's a lot.
Yeah.
Volkswagen Jetta.
Yeah.
Nice.
Yeah. 6'3", 250 pound.
Cut the top off.
Yeah. So, yep. So
I've seen him in my truck, dude. He looked like he couldn't sneeze in my truck.
Yeah.
Sitting in the front seat back and forth to Waco a few times. I'm like, holy shit, I don't have any room.
Right. So we just need to we need to get some more deals under contract. So look, if you can help me out, I'm just asking for a favor, guys. Just go to deepbluere.com. If you start going to deepbluere.com, there's going to be a ebook that we just wrote that's going to be coming out. You'll sign up for that. Once we do release it, so all you do is go to that sign up so that when we do release that, we'll send that to you via email. If you want the hard cover, then we'll figure something out. We'll hand make it.
We'll handwrite it.
Yeah, handwrite that. But look, if you're looking to increase your wealth, maybe have some tax write-offs and create some passive income, just go to deepbluere.com and sign up for our investor newsletter.
And then check out Tore Studios, Tore Studios, which is going to sound and look even better next week because we're getting all new microphones. I'm very, very excited. Jesse has created a really brilliant studio here that's only getting better.
So I hope our microphones look like Ryan's. I always want the one on the arm. I mean, his looks...
Yeah,
I'm going to invest with Ryan only because his microphone looks so great.
He's got the official setup.
He does.
Well, Jesse will have to show you what he's getting after this. But yes, check out TORETourstudios.com and you'll see the new setup next week. But speaking of awesome boom mics and awesome dudes, we are super excited to have Ryan Tanel on today from Top Producer Investment Capital to talk about his journey, what they got going on. We have a lot of similarities in our network, know a lot of the same people. I'm super excited to dive in with him and hear his story. So please welcome to the show, Mr. Ryan Tanel. How are you, brother?
Hey, guys. It's great to be on. Thanks so much.
Absolutely. Okay, so Jesse's going to nerd out. We're already talking about what kind of microphone do you have?
This is the Shure
SM7B.
I just looked up, the
Wow.
one that's standard
Rain
that they
Man.
use on Joe Rogan, and I said
There
that's
you
good
go.
enough
Yeah.
for him. It works for me.
100%, brother. I love it. So the Shure SMB what?
SM7B.
SN7B.
It's like the broadcast standard for like podcasts and stuff.
Love it.
I mean,
Just-
Joe Rogan uses. We don't even know if this is the real Ryan or Ryan AI talking to us.
Right.
Yeah.
It's complicated out there these days.
No,
right.
100%, man. Well, I appreciate you coming on. Like I said, I never like to tell anybody's own story for them. So we'd love to hear just kind of who is Ryan? Tell us about your journey. Get us up to speed, and then we'll really dive in.
Definitely. Well, I'm a good old Texas boy. I grew up in Dallas originally, and then I've moved to Austin, and I've been in Austin the last 14 years. So I started real estate probably about 10 years ago. Originally, read Rich Dad, Poor Dad books, read a lot of other real estate books, figured out that, if you just build an empire of real estate and own a lot of properties, they'll start cash flowing for you. And eventually you'll get to a point where you can just quit, retire, and choose to work or choose to not. So I like that dream. And so I said, I'm going to do what it takes to get there. So I started getting my license to do mortgage lending. And I worked for a mortgage company for the first 7 years. And along the way, we helped 600 families get financing for their homes.
Wow.
I bought my first duplex in 2016 as a house hack. So I lived in one side of the property. We renovated the other side, rented that out. And then I moved into the new side, renovated the other side out. And the next year I bought a single family house with 3 bedrooms. So I lived with roommates. They paid the mortgage for me to live there for free, and just, have been addicted. So I've just been buying a house ever since then. And then I'd say 3 years ago in 2021, I left the mortgage job to just be full-time doing multifamily syndication, since investing has been going so well for me. And so now we pool together investor capital, very similar to you guys, to take down good real estate deals of apartment complexes, usually on the smaller end. I think our smallest deal, we have 12 units up to 75 unit properties is the largest. So we'll pool investor capital together, and then we use that to buy a property that we can add some value to and get hopefully double investors' money over the course of 5 years. So we've gotten up to about 8 properties, 255 doors all across Texas. I only do Texas, Dallas, Austin, San Antonio, and kind of the submarkets around there. So yeah, it's an exciting journey so far, and can't wait to see what happens next.
Yeah, love that, man. Appreciate you sharing it. And you have really the a great, if you were to map it out in sort of the Rich Dad Poor Dad speak, a great prototypical kind of journey, right? Started with single family. Well, started with a duplex, but smaller amount of units, single families, things like that. Realized there's not a lot of scale here. I need to level up. If I'm going to hit my goals, I really need to get more units, utilize economies of scale. And so now you started to go the multifamily route. The mental hurdle there of going from single family to multifamily, in my opinion, is what keeps a lot of people from making that jump. Even though now that we're all in this space, we realize that because of the economies of scale, it is much more efficient. It feels very scary to do that first deal. It feels way different than buying your first single family home. Tell us a little bit about the leap from single family into multifamily. What was that first deal like? And what were the big things that you learned along the way, and maybe some limiting beliefs that you had around those deals that you were able to kind of crush by doing that first deal?
Yeah, I'd love to. So my mental state along the way has changed so much. So originally, I got into mortgage lending because I wanted to own a lot of real estate and have it be passive, but mortgage pays really well. I mean, right now with interest rates where they are, it's a little bit dipped, but at the time we were closing plenty of loans, and I was having, 6 figures of income, my first, second year on the job. And then it just kept growing every year after that. And so even though I was buying investment properties, it was difficult to get the mindset to step away from a really good income. I want to say my last year I had $290,000 of, W-2 salary, to step away from to do this multifamily full time. And then the mindset that I had though was when I would do my first duplex, and then I would do my house after that, each property, I would put, maybe $20,000 or $30,000 down, and it would make, after a year or two, we'd fix it up and it would be generating about $500 a month of cash flow. you get one repair, like an HVAC or something that goes out, it wipes out, 3 to 6 months of the profits that you get for that year. So it's difficult to really build it up. But in my head, I was thinking, okay, well, if I get to 33 of these, units that each pay $500 a month, hopefully net of repairs, then that's $200K a year. And that's enough of an income where I can, choose to work or not. So that was my goal the whole time, was work in the mortgage industry to get my active income and then buy these rental properties, get up to 33. The trouble was it just took so long, and it was very difficult to find really good deals because I was working, 10 11 hours a day doing mortgage loans. It's a pretty demanding job. And so I didn't have the time to get deals, direct to seller, off market, at a discount, manage a renovation crew, manage all of these properties myself. I eventually had property managers doing that for me, but then you pay them a fee. And so there's a lot of complexity that goes in there. And I would hear the stories of people even just doing single family flips. So they would make 50K, in one deal on a flip. And then I'd hear people doing, 10 units at a time, and they'd make, a couple $100K on a flip like that. And I said, big picture, the mortgage industry, I've seen people doing it 20 years. There's some of the top guys are making $1 million a year doing mortgage if they're really good at their craft, but you're still, chained to your desk doing the same thing over and over and over. And so there's not a lot of freedom. And the day that you quit mortgage, is the day that that income ends. And so for me, I said, I know long term, I'm going to have more freedom and I'm going to get where I want to go sooner if I can get into this multifamily space and figure out how to do deals directly, because it's extremely scalable, right? If you can flip a house, it's not that much different to flip a fourplex than to flip a 10 unit than to 32 and 100. So you just, you get better and you build your skills over time. And I've changed, I guess, careers. Originally, I was in the film industry, so I left that behind to do mortgage. I was successful with that. I bought a property. So I've had a lot of times where I've had to try something completely new and different and had success with it. So it gave me the mental confidence to say, I can leave my job before I even owned any multifamily and do this full time, because I would, I was underwriting a lot of deals. I was part of these mentorships and masterminds, and I saw how much general partners could do if, you do deals well and you are full time to find the best deals and operate them really well. So, I had, at that point, I think I had 7 units, all with pretty good equity, and then plus, 200,000 in the bank for reserve. So I had many years of runway to leave my job and take this on full force. But yeah, it's definitely that was kind of the mental hurdle. And I really wish I would have done it, probably, 2 or 3 years before I actually did end up leaving, or at least got started sooner. But I had a nice nest egg at the time, and now I'm very thankful for it, because it's been an exciting journey and it will scale much faster than if I had just stayed in mortgage the whole time.
Ooh, man.
Talking about a mouthful.
No, I love
That's
it. Man.
that just the quintessential story, right?
Yep.
Amazing. So, Ryan, what was you mentioned masterminds and investment groups and stuff, and you and I know each other through the Jake and Gino group, but what really propelled you to invest in yourself and that education, and really surround yourself with people that you could learn from?
Yeah, education and investing in yourself is, I would say, the best investment that you can really make, because if you put, let's say, 100K into the stock market, it makes 8, 10, 12% a year. That's a decent return. But if you invest in some education where you can double your active income, that's just a way better return than you could ever get on some passive investments. Yeah. And so that was important to me, or at least I realized that early on, that having a mentor in mortgage taught me how to increase my income substantially. Having these other programs helped me realize that. And I follow like Alex Hermosi and a lot of these other guys who have just great programs that when you follow them and you learn how to add skills to your knowledge base, those are skills that will never go away. So even if all the money goes out of my bank account, I'll still have the knowledge on how to get it all back much quicker. And I'd rather have that knowledge than just the money in the bank. So I guess coming to those realizations of saying that knowledge is more important than money in the near term gave me the confidence to say, let's just figure it out.
100%, man. I love that mindset. I actually had a different question lined up, but I'll circle back to it just because of that exact sentence that you just said there. This is something, you come from a background very similar to us in the sense of being comfortable with change, being comfortable with lack of stability of income and things like that. We're all entrepreneurs in this room. We've come from a place where we're used to the income not always being W-2 and steady and things like that. And so it's easier for people like us, I believe, to adapt to new things, to say we're going to jump full force into this and we're not going to have the anxiety around it because we're kind of used to that type of thing. I think that's one of the biggest things that holds people back, even high income earners who do it in a very concrete, more of a corporate setting, from going full force into something else, is they've never been put in a position where this has to work or they don't have anything else. It can be very, very uncomfortable. And I think that keeps a lot of people, like we call it the golden handcuffs, right? It keeps a lot of people doing things that they don't necessarily like doing because the income is steady and they know at the end of the tunnel there will be some sort of retirement, even if it's not exactly what they want. My philosophy has always been, you can train that mindset. If it's not just a W-2 job that is giving you security, there are other things in your world that you can do to continue to build the comfortability with being uncomfortable. What I tend to see happen with a lot of people that get really comfortable with their W-2 income is they also get very comfortable with their W-2 way of life. And what I mean by that is they do the same thing every day. They have steadiness in this area. They have things that they want to do, but it's inconvenient to go do them right now. Whether it's something like learning another language or exploring a passion or something like that, like doing the thing that they really want to do would take a leap. It would take a change in lifestyle. It would take something that makes them uncomfortable. And I want to put that out there as like actionable advice. If you're coming from a place where you really want to get into something like real estate investing, but it might take a big leap on your part and make you uncomfortable, I guarantee you there are things in your life right now that you really want to do that are way lower risk that will make you uncomfortable. And just consistently training your mind to be comfortable with discomfort will give you so much more latitude to go do different things. And that could be way outside of the professional realm, but there's a lot of things that I think we don't do because it's in our comfort zone to not explore them. And just like going to the gym every day makes you uncomfortable, but the results are there. I would invite anybody who's really comfortable in their way of life, but wants more, start with the things that you already know you're not doing. That might not even involve money, but I guarantee you there's stuff out there will help you expand your comfort zone.
Yeah, absolutely. Well said. And I think there are a lot of small baby steps you can take, right? I remember listening to a Spartan podcast a long time ago. And Dick Costolo, the former CEO of Twitter, was on the episode with Joe DeSena, and he had just run a Spartan race, and he told the story about getting up the day of the race and not feeling good, and he was like, you know what, I'm just gonna like get my shoes on and walk around and see how I feel. And he gets his shoes on, and then he says, maybe I'll just go down there and spectate. And then he gets down there and he's like, I might as well do it now that I'm here. Right. And he was talking about kind of the energy that he got and the satisfaction and how the endorphins were running and the culture and the whole thing. And sometimes you just got to take the little steps. Yeah. So let's kind of bring this back to our guests a little bit. Like, Ryan, as you were gearing up for this transition that you were going to make outside of the W-2, right? What kind of small steps or what kind of plan did you have to prepare yourself from going to so it sounds like a $25,000 a month job to zero, and kind of create your own runway to rebound from that?
Yeah, well, I'll tell you, the perception that it felt like, at least at first, that was really scary, was that I would be leaving something comfortable and jumping into something completely unknown. And so trying to mitigate that risk of just failure and floundering around and losing a bunch of money, I said, like you said, what are the small steps I could take? And I said, well, let me at least find the people who have done this before, who are doing it now, who I can learn from and follow in their footsteps, or maybe even help them. And so that's why, joining the masterminds were so helpful, because I got to see the people who were actually doing the deals. And, some of them were younger than me. It's like, well, if these guys can do it, like, I feel like I can definitely do it. I'm a young guy myself in this space. And there's some guys, 26, 7, 8, and they're all, owning, hundreds of units out there. So that gave me the confidence, but then also the resources to, learn how to underwrite a deal, and in Jake and Gina, we have a coach, right? They pair us up with 2 coaches. So I would call them up every other day and say, hey, I underwrote these 3 deals, tell me if, these were good underwrites, what feedback you would have, should I pursue these? Like, how would you evaluate each one of these? And over time at this point, I think I've underwritten 800 or 900 deals just in Texas. So I know most of the multifamily, at least, that's been, up for sale at some point in the last 3-4 years. But doing that first 100 to 200 underwrites gives you the confidence when you're doing it yourself, you're taking it to a coach, not putting any money or risk on the line yet, just saying we're practicing. We're just kind of going through the motions. But then, it's pretty encouraging when you get a coach who owns 500 units say, you got a deal. This is a good one. Now, on top of that, I'm not doing these deals just by myself. I have other partners. So massive capital has been a big one. My first deal I did with Shariah. He actually was the one who found the deal. He saw a lot of the activity that I was doing, and he says, hey, I trust that you're going to be a good operator. I want to do this deal with you because I'm busy doing bigger deals, but this is a small deal. It's good for you to get your first footsteps. Small deal is, 1.7 million, 32 units. I mean, that's not small, when you're buying houses, but it was small compared to what he's doing, hundreds of units now. And so we got another, guy, Leighton, on the team. And so between the 3 of us who all had lots of various experiences doing these deals, I was the most novice. We were able to do that deal together. And that first one, I learned so much by asking questions. So it wasn't as big or as scary as people make it, because every point along the way, I had mentors that I could ask for feedback, that they would tell me what to do. And I was just kind of following the action plan. Now, there have been plenty of instances in that first deal and lots of deals since that I have run into mistakes and issues that, mentors may or may not have been able to guide me away from, but I have learned a lot of things that I am going to improve on and do better next time.
Hey, if you're not breaking a couple things, you're not trying.
Yeah.
We've learned a lot along the way. And I love that philosophy around finding the right people. Matt says this all the time. It's all about who, not how. And I think that we've taken that philosophy into our business. We've been very careful to grow responsibly. And I think that's really good actionable advice for people that are in this space, because I think to be in this space and be successful, you have to have a little bit of crazy in you and have that wild ambition that can get you into trouble at times as well. We have to really rein ourselves in sometimes for not trying to do too many things at once, because everything looks good. And so we have to be very responsible about the deals that we do in the spaces that we get into. We're very fortunate to have just closed on our first storage deal, but we were adamant for a very long time that we were not experts in that space, and we were not going to do a deal just to do a deal. And so finally we have done one, and it's a JV with a very well-known, very successful operator in the space. And it's a smaller asset. It's an opportunity for us to learn. The deal is in all of our hands, so we're comfortable with it not going sideways. And if it's a space we decide is for us, we'll get better, we'll master it, then we'll go bigger. And so I really love that philosophy of the who that you surround yourself with, because not only does it open up more opportunities, it allows you to grow responsibly with people who have been there before, and you're not flying blind. So I think it's huge.
Well, and to kind of ask the right question on this, Ryan, when you got in 21, you went full time, right? Optimism was super high. We weren't facing the rate challenges or anything. Values were still going up. What was the goal of Top Producer Investment Capital then? And now, as we have transitioned into this new market space, has that goal remained the same? How have you kind of evolved with that?
Yeah. So the goal, originally I had a couple goals when I first started. So the primary one was kind of like anything. Like, I didn't expect the first deal to go well. Luckily, it's been one of our best deals, but I just wanted to learn. I wanted to get in there and figure out what it was like to do a deal. And that was really the only goal, was just to learn and be a part of the process and hopefully do better the next time. The other thing that was the goal at the time was, even though rates were low and prices were going up, I mean, they've come down in Texas since then, especially here in Austin. And so when a lot of people were doing these underwrites, we would have coaches say, put, 2 to 3% rent growth appreciation per year, put an exit cap rate at least, 50 to 100 basis points higher than the cap rate you're going in at. And, look at the comparables for where rent growth is. And there's just some assumptions that you make that are standard conservative deal practices. And then there's more aggressive underwriting assumptions that you can make. And if you're aggressive on your assumptions, every deal starts to look like a pretty good deal. So the question is, well, where do you draw the line on what's realistic, what's conservative, what's aggressive? And if you're too conservative, you're not going to be able to buy any deal. But if you're too aggressive, obviously you can get yourself in trouble. So that's why I rely on these coaches to say, where's that line? And they were good about saying, these are the assumptions that you should be making. Don't be going higher than 3% rent growth per year on inflation, and don't be trying to do 50% rent increases, above market comparables, on something if you don't have any other properties in the area. And so, it would be confusing to me because we bid on a property, let's say we bid something $3 million because I did my underwriting and I was like, okay, this is conservative. The whisper price is $4.5 million. We're bidding $3 million. There's a big spread, but maybe the seller will come down to meet us if they're desperate enough. Well, at the time in 21, out of the 150 deals or whatever that I underwrote, every one of them would be like, hey, the whisper's $4.5 million. We got offers at 4.6, 4.7, 4.7.5, and you're at $3 million. And I was like, man, and these are from groups that have been doing this for a while, right? Like, what am I doing with my underwriting? That's just, is it too conservative or, there's just such a disconnect. And so there was a lot of headspace in trying to figure out, okay, obviously if I haven't done this enough, is it because I'm being too conservative or are these guys being too aggressive? And so as we've learned, like, especially with these bridge loans, like the only people that were actually closing on deals during 21 was because they got these bridge loans that had a 1.0 debt service coverage ratio, and they did 85% loan to cost on top of the renovations. And a lot of the guys that won those bids, got, winner's curse basically, and said they overpaid for these deals. They're really highly leveraged. Rates went from, 3 to 6 or 7 now. And they're just stuck. And I hear a lot of stories with people that are, either facing foreclosure, kicking the can down the road, losing all of their LPs' money. And it just makes me thankful that I didn't go in. So I guess the goal first starting out was like, make sure I don't accidentally overpay for something because I don't know what I'm doing yet. Just wait and be patient.
Yeah. And I love that's that story because we've heard that story from many different investors and perspectives and things like that. And I think some really good actionable advice to take out of that experience, and I'm sure that you've learned this, is there are fundamental principles in any space that you probably don't ever want to violate, right? The uses of bridge debt on a lot of those deals probably violated a fundamental principle of a lot of people's underwriting. If that's the only way that a certain deal works, that's probably a certain asset class that you probably shouldn't even be using bridge on, probably violating a fundamental principle. And so I say that to say there's this fine line between always surrounding yourself with smarter people. You never want to be the smartest person in the room. And then also sometimes recognizing that all the other smart people in the room may have never been in this room before and everybody might be wrong. Like that's certain market environments, right? You get a whole lot of people in a certain market environment that are very smart. They might all start to wear off on each other and all start doing crazy things.
I agree with you, but so Ryan and I we had submitted an LOI on a deal in North Richland Hills probably 2 years ago. Right. And this was as the rate environment was starting to change and very, very quickly. Right. But before that, it was very hard to not get caught up in the hype. Yeah. Why? Because the market was on fire and every single OM that I got, right? And you looked at the financing and it was 80% loan to cost, bridge, right? 85% loan to cost with a floating rate. And then there'd be the agency option, and they would like do a really good job selling against it, and it would say 65% loan to value, right? Yeah. Plus all the CapEx. So it's like, shit, if I want this deal, I got to come up with, way more money, and I got to finance my own CapEx. But it's funny because those same brokers that were selling deals then, now they're coming back with the same deals. Yeah, they just need to get out. They're going to roll on to bigger projects or,
redistribute their capital.
Yeah, and then it's funny, man. But my point is, like, at that point, 21, 22, it was very difficult to remain stoic and not get caught up in the hype around what was going on in the market.
If you've ever, I'm sorry, I didn't mean to read The Madness of Crowds by Douglas Murray. It's about like groupthink mentality.
Yeah.
It's so easy for me and you to sit here and look back and say all these mistakes were made. I agree 100%. It's really hard not to get caught up in the hype.
But that's the beautiful thing about this show. And Ryan, I want to ask, I'm going to reference an old episode real quick, and then I want to ask about your investment rules. But we had on episode 31, Bill Ham. And something that's what I love about this show is being able to just enter in their minds really quick. And Bill brought up one of the rules is never, if it makes sense with bridge debt, it's not a deal, right? And Brian and I are in a deal that everything looks great except for the bridge debt. Yeah. And it's crushing that investment right now. Yeah. And it was a home run of an opportunity, but it only made sense with bridge. And, Bill in episode 31 talked about all that, and he had his specific rules. And if it violate any one of them, then you don't do the deal. So Ryan, what are some of the rules that you have that you everything else checks the box, but maybe one thing is off and you're like, all right, we're not going to do it?
Yeah. I mean, when we do these underwritings, we try to get limited partners to double their money over the course of 5 years. Right. And we can pull a couple of levers. I'm really a spreadsheet and a number guy, but a lot of those are formulas, right? So I plug the data in and I try not to just be too aggressive on, the rents or the growth or like the expenses. I try to put just kind of my standard numbers in there and not inflate the numbers if I just really like the deal for some reason. But I'll tell you the things that most of the deals I just won't even look at. If it's got a full offering memorandum from a broker, it looks like another group has already renovated part of it. There's just a couple qualities about deals where if I think that the sellers are trying to get market price and there's not a need for them to sell at a discount, it's not even worth looking into. So yeah, I'd say the first thing before I'll even look in the deal is just what's the story, right? Like, why is the seller selling it? What's the reason that they might be motivated to sell it at a discount? Or, what's the value that we can really bring? And the other thing is, when I look at it, I say, okay, well, I think I can do the basics pretty well, but I'm not a genius. So if I look at this, why would our team be able to do this better than they're already doing it, right? Like most of these people that buy multi-million-dollar deals aren't dumb people. They know what they're doing. But, for whatever reason, maybe they got carried away. Maybe, they got distracted on something else, their management company. So what can I do that is going to be, exponentially better than they're doing it right now? So those are the two things is how can we get in there and just buy it in a way where we're getting a definite discount. And then I look at the comparable sales and say, okay, this one sold for 140 a unit. This one sold for 150 a unit. We're buying it for 90 a unit. And after we fix it, we're all in for 105 a unit. And then the comparables are all at 140, 150. It's not a whole lot of underwriting that you need to do to say, okay, that's a pretty good deal. Like my partner Leighton says, it's good to have underwriting spreadsheets, but like all the real estate that he's bought, he didn't need an underwriting spreadsheet to tell him it was a good deal. He just, he had looked at enough properties and he said, yeah, this one's like 30% cheaper than the rest. And it's not going to take that much to fix up. So, so I'd say that's the main thing is just knowing the seller story. How are you going to fix their problem? And, if I know there's going to be a ton of competition on the deal, it also just doesn't seem like a good deal anymore. So being the only one to solve the seller problem when their financials are not the most important.
And well, that's, that goes into, if you go to your website, Top Producer Investment Capital, you have a list of 100 questions that top producing investors should be asking. Is that part of the 100 that investors should be asking? Could you share a few of those? Don't go through all 100 so they just go to your website, but give us some of those sample questions that investors need to ask, GPs and operators on.
Yeah. So what's interesting, I have that on there to help limited partners who are not really real estate people try to understand if this general partner or this sponsored deal is actually a good deal or not. And so, because it's hard. I mean, I even look at other general partnership deals and everybody, when they make their investor offering memorandums, their sales pitches, right? They're going to look pretty. They're going to have good photos. The numbers are all going to be great. And they're all going to be, good looking deals.
Feel real good.
When you look at those. So how do you really get behind the scenes? So, and I've reviewed a lot of other investors will send me other offering memorandums and say, hey, can you provide some feedback? I think everybody should do that. If you're an investor, I think you should get an offering memorandum and send it out to 5 other groups and say, give me questions and feedbacks that I can, nail down this group with to see if it's legit. I think you always need the underwriting spreadsheet. If you're looking at, they'll usually have like a PDF or some kind of document where you can see the underwriting numbers. but they won't give you the Excel unless you ask for it. If you're really going to review a deal, you need that Excel underwriting so you can know how they did their calculations, if they're how they're increasing numbers here and there and what formulas they're using and what their exit cap rates are in the actual Excel, not just their offering memorandum. The other thing, I mean, track record is probably the best indicator of success, right? If they've been in business 25 years and they can point to all the deals and say, yes, we exited this one at a 17 IRR, this one was a 25 IRR, and they can point to all of those. That's a huge indicator of success. You also want to ask them, are you going into a new market, or is this something where you already have worked before? Is this an asset class that you've done before? Is this something that is going to be brand new for you guys? And, what's your experience in all of these things and in the track record? Yeah. So, and some of the things I mentioned before, what's your assumptions for exit cap rate, increase on rental growth over time, and where did you pull your rental comparables for? Where did you pull your sales comparables for? Did you just cherry pick the prettiest ones? If you're serious about doing a deal, I mean, you should run your own comps and say, okay, well, yeah, they picked, some A-class buildings, but this is really a C+ building, and we need to go to this comp over here that's a little cheaper. And the other thing I would say is, if you're investing, $100,000, it doesn't take much to run a background check, a credit report on the sponsors to just make sure that they're serious, real people. Because there's I hear so many scams of people that they hear a good story and they get into a deal, and turns out the dude is just committing a scam, didn't even use the money to buy a property. So I hear that those kind of things are out there. So yeah, checking on the due diligence of who these people are. And then let me see. I want to say, what's I found is so interesting when we're raising capital for our deals, we have two kind of investors that come in. So we usually have people that have had some real estate experience, or they're like engineers, number people, and they have a lot of questions about every number on there. And I get along well with those people. I'm a numbers guy. We can go over all the numbers. And then I get some people that are just story people. They want to know the story. They want to know how it's going to work. They don't need to see all the numbers. They just kind of trust. But most of the time, I do not get verified as much as I think I would verify another sponsor, or I think limited partners should verify. So most people in general are very good to trust, and you guys are trustworthy. I'm trustworthy. So it's helpful that we are the good guys in all of this. Yeah. But yeah, I think most limited partners need to do way more diligence before they get into something if they haven't done it before. If you're sending, 50 or 100K into a new group, you should really have checked them out and vetted them with people who know what they're doing before you send out that much money out.
I agree. And at the very least, one, like you said, check out the sponsors, dig deeper there, and learn to speak the language. As an LP, the whole premise is that you're probably working another job or doing something else, and you don't have the time to invest in being a GP on these deals. And so you're looking for a way to passively invest, but that doesn't mean you can't learn to speak the language and not fully underwrite, but be able to vet a deal and look at an underwriting model and say that, at least those cap rates or rent growth or whatever, that is realistic. Having a basic concept. It's the same way. I mean, if you were going to go put money in individual stocks rather than an index fund, I would hope you'd be able to at least tell me what a P/E ratio is, right? Yeah. Otherwise, just put it in the S&P and let it go. So I think having a really basic level understanding of what the sponsors are talking about when they talk about underwriting and being able to ask good questions is a really good way, or really good familiarity to have. You said something earlier that I think is really important just to double tap on as well about deal flow that I wanted to circle back to. We get very caught up in the romanticism of every deal. Lots of deals come through that we're probably not the right buyer for, but that doesn't mean there aren't buyers out there. And as a sponsor or aspiring sponsors, I like to always try to give actionable insight. And I think this is a really good one. When you're talking to a broker on a deal that you feel is not in your wheelhouse, as far as the whisper price, you can't get there, it doesn't pencil for you, and the broker is kind of making you feel like, well, we've already got a bunch of LOIs, that might be a different buyer profile that you don't fit right now, right? It could be a 200 unit class A minus, class B plus deal that works really great at the institutional level because their yield can be lower and that fits their business model perfectly, but there's no big value add opportunity for you. So for your business model, you're not the buyer. So we need to get emotionally detached from the fact that there are buyers out there that we don't need to feel like we have to compete against. This just might not be the right deal for us, even though we love the location, even though we love the asset. It might not be in a part of its life cycle where we're the right buyer. So don't be deterred by the fact that there are other buyers out there that it might fit perfectly for. Totally different business model.
Yeah.
No.
Good point. That was a mouthful.
That was a mouthful.
You're on fire
Now
today,
I'm
dude.
talking a lot. I know.
I like it.
It's my gym shorts.
Yeah, it's the gym shorts and the caffeine.
It's the gym shorts.
So Ryan, you guys you're invested in a bunch of really good markets in Texas, right? Tell us a little bit about your observations in performance across those markets. You mentioned San Antonio, Austin. I think you've had some stuff in Dallas, right? What are you seeing in those markets from a geographical perspective?
So I have been surprised with the performance of Dallas. So we have, I only have one 12 unit over there right now, and it's in the hood, like it's in a rough area, but the building itself looks great. And we've, made it look even better. So we're getting them rented, but the interesting thing is, as far as like the exit sale price and the exit cap rates over in Dallas, I've just been impressed that it has been hit less hard with rates going up. I think it's maintained a lot of the values over there. And the other groups that I've talked to that have properties in Dallas, they've been a little more stabilized. I think maybe Dallas is just a more mature market. Maybe it was affected less by the hype of everything that happened in 21 and 22. But Dallas, I think, has been performing well as far as, our vacancy has been low. We're hitting the target market rents that we want, and exit sale price and cap rates have remained somewhat constant. We have a deal in San Antonio. It's a 75 unit deal, and it's interesting. It's in an okay area. It's a 1964 building, so it's definitely older, but it was renovated really well, and so it shows really well on the inside. When you drive by it, one of the comments we get from everybody, even though they see our advertising, they'll come in like, wow, this is way nicer on the inside than we thought it would be, just kind of driving by on the outside. So we're trying to put some banners on the outside of what the interiors look like to be like, it looks this good, please come inside and take a tour. But yeah, San Antonio, we get, and maybe it's because it's 1964, our rents, we're trying to get 2-bedroom rents up to $1,200 a month. We get, I'd say like 70% of our applications are either like Section 8, and we don't accept Section 8, but they're like asking, do you accept housing vouchers? Do you accept felonies, evictions? Just they have a lot of difficult residents over there that have problems getting housing. And so you have to sift through a lot of people to get the good ones. And then even then on our San Antonio property right now, we're having like 20% delinquency where people are, signing up for this rent. They get, 6 months in their lease. Maybe they have lost their job or, whatever happened. They just don't have the money. And so they'll do payment arrangements. They'll, promises to pay, but we end up doing probably 2 evictions. At least this year, we've done like 1 to 2 evictions a month with people that get behind. And then we're constantly having to run specials to get people either back in or, lowering the market rent, maybe $50 on a unit type every now and then, just to, make sure that we're kind of with the market. I've also seen San Antonio, when we bought it, I think market rents have dropped $100 from we bought this in fall of 22. I'd say the market, and we're in Northeast San Antonio for the C class, is probably dropped about $100 from when we first bought it.
Wow.
That's still on our pro forma that we have to hit our numbers. So even though we're getting leases signed at, our market rent was $1,250 to hit year 2. And so we're getting leases signed, but it's like, we'll get 1 lease signed a month. And if we have an eviction a month, plus somebody doesn't renew, that's okay. Well, now we're occupancy is dipping lower than it needs to be. And so we're having to decrease the rent and run some specials to get more velocity of leases so we can get 2 or 3 a month to kind of make up for that. And part of it is, as some of the residents have been there for, since we took over. And if their rent goes from, $800 a month or $900 when we took over, and now we raised it to $1,200 on their renewal, or maybe even only $1,100, the reason they might be delinquent, not because their situation changed, that we just raised the rent. Yeah. And now it's just harder for them to qualify. So they're getting behind. And so we're seeing a lot of that. And so our hope is, the market softened. Let's, find the place that the market rent is good, where everyone renews, we can get the delinquency down lower. But that's what I've heard about a lot of San Antonio, is that delinquency is high. Market rents have softened, I'd say about $100 in the last 2 years. And so that one's been tough. The deals that we have I have a small one in Gonzales. Gonzales is like a small town, hour southeast of here. That one's just been doing great. I'm surprised with the price that we bought it at compared to where our market rents are. We bought these at like 54,000 a unit, and we're getting, we put another, I'd say 10K unit into these between interior and exterior, and we're getting like $1,000 a month for rent over there. Like, it's crazy. Like over the one, it's like 1.5 to 2% rollover. It's like super high. So that's been an interesting market. I kind of want to spend some more time maybe looking at more deals over there. I would say nothing's really softened over there, and people just need a place to live. And then the deals that we have in like Austin and Round Rock they've been doing okay as far as leasing. I'd say vacancy has dipped to, like the, high 80% across the market of Austin. Just because I think I read a news article that the last, year, maybe it was 23 or 24, was the first year that Travis County ever lost residents. That most years you would get like 5% population increase in Travis County because everyone's moving to Austin. Well, I guess Austin got so expensive, and all the tech companies, which is a majority of the downtown workforce, is starting to lay people off, that it doesn't make sense to live in Austin anymore, but it still makes sense to go to a city just north or just south, and pay a little bit cheaper, but be able to commute 20 minutes to get into Austin for those kind of jobs. So we're still seeing, I'd say ability to lease in the cities. Like we have properties in Round Rock. We're still able to lease in Round Rock up there, for a decent product, and we're getting, decent residents in there. But we are seeing, just a softening where we can't push market rents. We're having to run 4 to 6 week specials for, hey, you get 4 weeks or 6 weeks of free rent, because that's what all of our competitors are doing right now just to get people in there. And I would say, even though we haven't had rents dip yet, I'd say there's a tendency we might need to see that with, especially in Round Rock. There's a lot of A class. I think there's like another 3,000 units coming online in Round Rock this year. And so it's hard when we look down the street and we're like, well, our rent is $200 less than that brand new building that has a pool and a gym and, amazing stuff. And I was like, yeah, for $200 a month more, you get all that. I'd go over there too. So I think we'll still see in Austin and Round Rock, with all the new products coming online, further dips in like B and C class rent, because everyone will just go to the A class stuff that's being built.
Yeah.
But I also think that there's going to be a shortage when there's all this new construction that probably put a pause last year when interest rates went up. They're going to finish out what they've got. They haven't done new starts because, at 7% interest rate, it doesn't make sense to start construction. So they're waiting until rates come back down to start construction. Yep. So hopefully between, 25, 6, 7, we start to see a gap where rents start increasing again, and sale prices for some of these products start increasing again. But, we'll just kind of see how many people keep moving to Austin. Yeah. They're building Samsung up there, that Tesla's there. There's a lot of companies that are here, but I'm seeing 1 or 2 news articles that are saying companies might be choosing different headquarters instead of Austin. So I'm still bullish on Texas in general, and even Austin. I still think people are going to continue to move here. I think it's a great city, but it is interesting to see some of the new articles about, maybe we'll see some people move to cities, maybe not Austin specifically, but maybe surrounding cities.
Yeah. So that's awesome. Let's go back to something you said before about your asset in San Antonio, right? So you mentioned that rents have softened a little bit. You're signing maybe 1 new lease a month, but you have 1 eviction a month, or and then maybe somebody doesn't renew. What does that conversation with your PM team sound like? And how do you, as a GP and deal sponsor, kind of manage them to help you right that ship?
Yeah, we just crack the whip a little harder, come on, get after it, it's just a conversation, right? And so there's 2 ways to try to figure out, right? Because like property management is a difficult game. It's not a big margin business. We're paying our leasing agent over there like $70,000 a year plus benefits. So like, if you were really good at real estate and you really cared, you could find jobs that pay more than $70K a year to go and do. So you're kind of working with people that are, just a certain talent level, and they only care so much about these properties. Now we have been blessed, like especially on that property, she really does care about us and doing the right thing. But there's some things she's good at and some things she's not. So when we review these, I'm always having to figure out, okay, are we having difficulty because is it a market problem, or is it something that we're specifically doing? So whenever we have anything that's not hitting pro forma, we definitely really dig in, and we use Resman as the software that we've got. And I say, okay, well, let me see the leases that we signed recently. If we've had eviction, what was our screening criteria? Did we give any exceptions on, credit score or income or something that we might have missed? Let me look at all the marketing. Are we not getting leases because people don't even know that we exist, or are they like visiting our Google My Business page or Zillow ad and just not calling us? Or are they calling us but never getting a tour? Are they getting a tour but not leasing because they saw something? Or hey, what's the feedback when they're on site? Are they telling us the price is too high? Are they telling us it's ugly? We've got to learn where the problem and where the disconnect is so that we can solve it. And so it's a big process of doing all that. And we have uncovered a lot of problems or things that we can improve upon, opportunities that we can improve, where we say, hey, in the sales conversation, because the calls get recorded. So I'll start listening to the sales calls, and, we notice that someone will say like, oh, hey, do you guys have any 1-bedrooms? And, they'll just say, nope. And you say, well, hang on, this is a lead. Could we say, hey, our next 1-bedroom looks like might not be available 2 months. We have a 2-bedroom available right now for $1,200. We're doing a 4 weeks free leasing special. Is there a way I could get you in here in a tour? Like, something like that could work. Maybe you could use the other bedroom for an office, and trying to improve their sales skills to try to, keep the leads fresh and figure out where the problems are. But we've done a fair amount of that. And so I'd say 50% of our little tactical things like that we can improve. And 50% is like, yeah, we just didn't have a whole lot of traffic this week. And, like we did the same time last year. So it might just be the market too. So it's hard, but I'd say that's our job as asset managers, is to dig into every aspect of the process and see if there's anything that we're missing, or if it really is just the market and the only option is lowering rents.
Right. Yeah, I think Bill Ham said, very, very succinctly, right? There's 3 reasons why apartments don't rent, and it's condition, marketing, and pricing, and pretty much in that order, right? One more question on this is, and both Brian, all 3 of us, Brian, Nick, and I, right? We have some sort of leadership responsibilities, both toward each other and in our businesses. How do you draw the line, or do you draw the line between management of the PM and micromanagement of the PM? All right. And what does your cadence look like?
Yeah. I tend to err on the side of micromanaging, I guess, because I love to just get in there, and, maybe there's some part of that that's healthy and some part that's not. I mean, it definitely ruffles a lot of feathers if I'm in there and people are, like getting exposed on things that could be done better. And, at the end of the day, like, it's not my management company. So if a property's not doing well, I can have suggestions about how they could do it better. But, it's their management company to really run how they want, and they can only take my suggestions, but it's up to them to really perform. So, if the management company is open and receptive to feedback, we can say, hey, here are the things that I found that I think we can implement. But big picture wise, I think you just have to set targets and say, hey, for Q1, here was our pro forma budget that you as a management company agreed to when you agreed to manage this property. We are, 10% over on expenses and 8% low on revenue. You guys need to help explain like what's going on here and not have it just be on us, and set some targets. Say, okay, well, if by the end of Q2 we haven't made progress to, cut expenses by 5% and increase revenue by 5%, or if things have gotten worse, then yeah, we need to start looking at other options for management. So that's really the only thing you can do to hold them accountable, is change entire companies. If you're giving feedback and they're either not listening to you or, not doing it, but it is your property, you should have access to all the reports, and you should be able to dictate, how you want to run it. But yeah, it does step on some toes if you're getting there and micromanaging. And I guess the reason I get in there and do so much is because, if we have limited partner investors, I have an obligation to them to make sure it's being done properly. If it was just my money and I wanted, time freedom to go off and do something else and have this just be passive, sure, let the management company do whatever. But because we have limited partners that we have a responsibility for, I'll get into every nook and cranny that I can.
Nice. I like that.
Yeah, that was really good. I mean, that's something that we as we're operating this, especially in this kind of roller coaster of a market, 1 minute you're riding the high and the next minute, you experience high, high delinquencies, and it really starts to affect the P&Ls and operations. Is like, at what point do you pull the plug on the management companies? Because again, that's changing management companies also hurts operations temporarily, right? So as you're doing that, Ryan, do you guys have, if they've missed one quarter of it, or do you just put it on a case by case basis?
Well, yeah, we have weekly KPI calls. So on every KPI call, we're going over the metrics, and it's very aware of if we're continuing to decline. But yeah, I'd say on a quarter by quarter basis, we say, hey, here was expectations, here's how far off we are, and then here's the expectation for next quarter. And if we continue to be off by, like, here's the line in the sand, right? If you guys are off by more than this, we are going to look for a new management company. So yeah, it's a tough conversation to have, but you have to have it so that they know it's serious.
Do you put that in the PM agreement, or is that just all kind of verbal?
Yeah, in the first couple, I don't know if we had it in there, but yeah, definitely moving forward, we do. If it's like, hey, if the budget, basically pro forma NOI is off by more than 10%, we reserve the right to look for new management. I would say that should be in the PM agreement.
I like that.
Love it. And to be respectful of your time, Ryan, and we truly appreciate it. What are you, as we're moving into the, the next 12 months and election year and everything else, what are you super excited about in this market?
Man, I'd say, multifamily is tough right now. I could see a world where there is a lot of these bridge loans where people get into a lot of financial distress, and maybe some opportunities come up where deals are done cheaply. But I'm seeing a lot of buyers still on the sidelines that are making offers, and groups that, hey, if rates come down even a little bit, people will say, okay, cool, we've turned the corner, let's get back in, let's get in the next boom. So I'm curious about, how multifamily is going to do. We have one little boutique hotel. I'm wondering, with everybody getting out of, like, Airbnbs are not doing so well right now in short-term rentals. So if people start getting out of just the Airbnb space, maybe boutique hotels will do a little bit better. But I in the next 1 or 2 years, I also see recession getting a little tougher, more unemployment. So I think if that happens, people will travel a little less. So the short-term space might also be a little tough. Real estate, I think, is just tough right now. So I don't know if there's anything to be excited about in the next 1 to 2 years, except for a lot of the other operators and competition getting out. And if you can weather the storm, stay in there and be patient, and only do really good deals, any deal that you do now, if it works at a 7% interest rate, when interest rates do get to, 5% eventually, who knows when that'll be, it'll be a great deal. So I think, yeah, just kind of stay in the course and thin in the competition is what I'm excited about right now.
Love it.
Awesome. Ryan, this has been great. Appreciate you coming on and sharing your insights and your story with us. Congratulations on all your growth in just, 3 years, right? I've watched you from afar, and you got the amazing bachelor pad / REI mastermind house. That's absolutely awesome. Congrats to you and all your success, brother, and look forward to staying in touch and hopefully having you on again here as we turn the corner and return to the new normal.
Yeah, the new normal. I want to hear what he's excited about then, because, we've got to find ways to be excited now, because if not, I mean, this beard's only going to get grayer. People, should we so people can find you just at topproducerinvestmentcapital.com?
Yeah, topproducerinvestmentcapital.com is probably the best way to get in touch. There's like a little form if you want to invest now. Click the box and it'll get in touch with me. I also have Instagram, Ryan Tanel, TPIC, is if you can find a lot of our video content there as well.
Awesome.
Thank you, Ryan, so much. And guys, if you enjoyed this episode, and hopefully you did, because it was a really, really great one, please go into Spotify, go into YouTube, subscribe there. Spotify 5 stars, podcast 5 stars. You can go to our Facebook page, Deep Blue Capital Facebook page, LinkedIn.
We got it all.
We are all over the place. You'll see our videos going up, our shorts, and not literal shorts. So I have shorts on right now.
You and Brian both have shorts on. I didn't get that memo today.
Well, I wear polo on the top and shorts on the bottom.
Yes.
Yeah, just for podcast.
Thanks for telling everybody.
I just want to give a visual in case you're listening audio only and not watching the video. So 5 stars only, and then go to deepbluere.com. Go sign up for our investor newsletter, as well as you're going to get on our list for our book that we'll be releasing very, very, very soon. That's coming out, and that way you get up to date on our next webinar, and you'll know things like the 32 unit that we're soon to be closing on.
Any day now.
Any day now. So that's a fun one, and all the other investments that we are currently underwriting. And who knows, we might be bringing storage after closing on our first storage investment
I'm
property.
excited. We're going to document the heck out of that.
Yeah. Well, we're going to celebrate tonight.
That's it.
Yep. Steaks at the
We're
club.
taking the kayaks to the country club.
That's right. So you want to have an awesome studio experience just like this, go to tourstudios.com, talk with Jesse. And we're so jealous of Ryan's setup over there. We should have mic stands that look just like
we have mic envy right now.
Yes, yeah, mic envy. So, all right, Ryan, we appreciate it. 44 is in the books. Leave us a review. Hopefully we'll see you on the next one.
We will.
No, we will see
We
you on
will.
the next one.
Yes.
That's right. All right, take care.
Thanks, everybody.